All right. Hello, hello. Can everybody hear me?
Yeah, I can hear you.
Yeah, beautiful. Man, I'll be honest, I'm not feeling the love today, guys. I only got one person in the office. Everybody else is relaxing from home on internet land. I'm not feeling the love. Not feeling the love. So I'll give everybody a quick minute to hop on here. But I'm excited. I'm super passionate about this topic. I love like everything there is to know about real estate. Love every aspect to it. And so, like I'm a living proof that whatever, getting in rooms and surrounding yourself with people that are way above and beyond where you are, right? It challenges you to be better, it challenges you to think differently. And if you break it down, everything is accomplishable, right? But sometimes like taking that first step is probably the hardest thing. It paralyzes a lot of people, right? So my goal today is kind of break it down, get it in really bite-sized chunks so that you guys have all the tools, information that you need. All right. So guys, I want this to be as interactive as possible. Okay. Now because we're in a lot of you guys are on Zoom with one person in. Thanks for coming.
Yeah, no worries.
Yeah. We'll love to hear some feedback from you guys as we go throughout this, okay? Because I'm gonna ask you some Q&A. But with further ado, let's get started. Okay, so real estate investing seminar. All right. Um, I'm going to just okay. David, just watch the chat as we go through this because I may miss people. But all right, guys, here's what we're gonna go through. Before I get into anything, I got a disclaimer, okay? This is educational, and I have to say this, okay? It can't be construed as legal advice. I'm not an attorney, okay? I'm not a tax professional, I'm not a CPA. This is not investment advice. I have no fund to offer you guys, okay? So you should consult with anybody about doing this, about any steps that you're gonna take. I'm speaking from not only personal experience in doing this, but also helping a bunch of people with their real estate goals. So here's what we're going to go through today, okay? And again, this is going to be like drinking from a fire hose. So it's going to be a lot of information. Okay, we're gonna go through everything A to Z. I'm gonna try to knock through as much as I can in the next hour and a half. Okay, when what we'll probably do is for the next hour, I'm just gonna go with some feedback from you guys. Right, we're gonna stop, ask some questions from you guys, and then we'll probably leave like the last like 15-20 minutes for Q&A. We can kind of go through specific situations, questions, and topics from you guys. Does that sound good? Can I get like thumbs up here? Thank you, Steven.
Yeah, guys, feel free to turn on your mics too. Just you can call and respond with John, it's no issue.
Yeah, awesome. Thanks, Katie. Katie, good to see you here. Awesome. All right, so here's what we're going to go through. Expectations for real estate investing. I'm going to walk you through my journey in real estate investing. I hate it when a speaker gets up there and has like zero credibility, right? That's like a pet peeve of mine. So we'll go through my journey. We'll talk why real estate. We'll go through how to find properties. All right, and we'll go through how to fund properties. Okay, so there's like finding the money, right? So you got to find the property, but sometimes half the battle is finding the money for it, right? We're going to go through the tax benefits. We're going to go through legal structure on how to structure it when you go to purchase it. We'll go through insurance, property management, renovations, how to analyze deals. I brought some properties with me today. I just have a couple, but I've got a bunch others that are not on here. And then we're going to go for a recap. All right. So without further ado, let's get into it. All right. So real quick, my journey. So I've been a real estate agent in the real estate space for the last 12 years. Okay, I've personally sold over 500 homes across Northern Virginia, DC, Maryland. I'm ranked in the top 1%. I got a bunch of accolades, but honestly, I'm just super passionate about helping others build wealth through real estate. Now, that it really kind of like hit me. So when I first got into business in 2013, right, I would help people sell. And I think it was like 2016, 2017. I would help people sell and they would make hundreds of thousands of dollars by selling their property. And they were there for, 5, 10, 15 years. And I'm over here thinking like, oh my gosh, that person's making more from the sale of their house than they are at like a whole year at their salary. Right. So imagine if you just bought one property every couple years, right? Like on how much of a transformation that'll do not only for yourself, but for your family, like everybody around you, like massive impact, right? So that really hit me with a ton of bricks. And what's funny is as soon as I started seeing that, I was like, you know what? Let me start buying property for myself. So I would dabble, right? I flipped the property, kept a couple, right? Um, and then I'm in a room with somebody else, right? That's always how it happens. And this guy was like, hey, everybody needs to build out where you want to be in the next 5, 10, 15, 20 years on how you want your real estate portfolio to look, right? Based on like asset cash flow coming in. And so I personally started doing some numbers for myself. And I very quickly realized, oh my goodness, if I keep buying like one every couple of years, it's going to take me like, a very, very long time for me to hit my goals. So I was like, man, I need to accelerate this like at a rapid pace. And that was in 2022. So I've bought a handful of properties. I bought four last year. And personally, right? Bought four last year. I bought two this year so far. I just closed on my 12th today. Um, and so I'm right there beside it along with my investors. Like I'm walking the walk and I'm super passionate about it because once you guys understand this, there takes a high level of discipline that's required for real estate investing, but once you understand it, it'll open your eyes to the possibilities. And let's be honest, if it were easy, everybody would do it, right? So the first one's the hardest, right? And every other one you do, it becomes easier and easier and easier, I promise. So that's my journey. Okay. So real quick, let's talk. Why do you want to invest in real estate? Because everybody has like different reasons, right? So Steve, I'm gonna pick on you.
Yeah.
Why would you want to invest in real estate in the first place?
I think it's a great investment, right? Obviously, if you live in the house, that's awesome, but then, it's an appreciating asset, so when you sell it, you're gonna make, you get the tax break, but then also, you're probably gonna make money over the course of the last 30 years or, right?
Yeah.
So,
It's like a forced savings account,
yeah,
right? Kind of forces you to do that. Awesome. And anybody else? Why do you want to invest in real estate? Anybody? Bueller?
I'll go. I
Yeah, let's hear it.
don't even know if you can see me. My kids are probably running around crazy right now.
Yeah, I get it.
I kind of landed here by accident. I was in the Navy for 13 years and bought a house young, sold it, made some good money. Wish I would have kept it. Bought another one, sold it. Wish I would have kept it. And now I have a property that I am renting out in South Carolina and I'd like to not just turn it over this time and see where we
Yeah,
can. So,
I love it. I love it.
mhm.
Yeah, sometimes we become like uh it's the other way. It's like sometimes people become like accidental landlords, right? Like they go to sell their property and they can't sell it. They're like, dang it. And then they throw a tenant in it like begrudgingly, right? And then a couple years pass and they're like, wait a minute, dang, this actually worked out pretty well. Right?
Yeah,
So
I
it's funny.
wanted to keep and it's good. I need to be able to learn and grow from here. So,
Yeah. Yeah, yeah. That's
Got
awesome.
a got a couple in the chat, John. I'll read them to you. Ferris says retirement and to pass down investments to our kids.
Oh, I like that. To pass down investments to our kids. I love it.
So got another one from Kaylee to fund retirement, kids, and future generations.
I love it. Look at this future generation stuff. We're going to talk about that too.
And
Uh,
Maury as well. Generational wealth for my kids.
oh, I love it. Look at you guys. Generational stuff. I love it. I love it. Um, cool. All right, so let's talk about benefits of real estate. Okay. Leverage, highly leverageable. Okay. So if you go buy an asset, you actually, let's say you bought something for $400,000, right?
Right.
you actually don't have to take $400,000 worth of cash to buy that, right? Like if you were to go buy Tesla stock, right? If you were to go buy that stock, you bought that stock and then like you needed the amount of money for that stock,
Right.
right? Real estate, you can put down 3% towards that asset and have it grow over time, right? So it's highly leverageable, right? Second is cash flow, right? So every single month, if you do it right, if you buy it right, it will pay itself down. So you put tenants in there and they basically pay it off, right? You get the appreciation. So a lot of you guys have seen this recently, right? The real estate appreciation has gone bananas these last couple of years. Hopefully it's like getting out of, getting under control. Now, typically it's like 3% plus or minus 3, maybe 5% per year. Right? During COVID, it got up to 20%, which is bananas, but you benefit from the appreciation. You benefit from the tax benefits, right? And we'll go through all the tax benefits. Control predictability, very predictable, right? That the housing market moves very slow over 30 years. So there's a lot of predictability there. Now, a lot of intangibles are it increases your net worth, right? So when you go to pass on assets to your kids, boom, like you've got very easily accessible assets right there. And then when we're talking next level stuff, okay, it actually helps you negotiate better terms when you're buying and acquiring businesses, okay? Because if you go to like right now, for a perfect example, if you go to buy a business right now, business rates are insane. If you guys ever get an SBA loan, they're I don't want to say the word terrible, okay? But it's incredibly challenging because they're actually adjustable rate and they adjust every quarter, right? So like, for example, there's a lot of business owners that bought or they got a loan in a couple of years ago, 2022. And when the Fed, every time that they raise those rates, guess what happens? Their interest rate goes up significantly, right? But it's not on a yearly basis, it's on a quarterly basis. So like I bought a business in 2022, I went from 6% to like 11%. Like, holy cow, like strangles you, right? So a lot of business owners have been like getting rough. So right now, the beautiful thing about real estate is if you go to buy a business and you say, no, 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 I'm not gonna go to the traditional marketplace and go get a loan. I'm gonna if you can talk to a seller about seller financing it and you wrap up your real estate in it, the seller feels much better being protected and you can negotiate better rates and better terms on the business. So this is like next level stuff, you guys. So again, real estate is at the fundamental core of that. So it helps you tremendously negotiate much better terms when you're buying businesses. And so when some of you guys are talking generational stuff, maybe you're not thinking about that right now, but maybe in 5, 10, 15 years, you go to do that, it'll help you immensely. And you don't even know about it, right? Or a lot of people don't. So I got this from the National Association of Realtors, okay? So if you just look at the net worth between a renter and a homeowner, the numbers are staggering. Like absolutely staggering. I mean, you're talking in 2022, the net worth of a renter was $10,400 on average, right? Versus a homeowner, you're looking at $396,000. Now, this is for one renter per one homeowner. So if you guys in the room are like, hey, I want to invest in real estate, I want to acquire multiple properties, guess what happens? That 396 becomes, or that just round up and say 400,000 becomes 8, becomes 1.2, becomes 1.6. Do you guys see the levels of scale? Like it is insane. It is insane. So it just a simple analogy. Now, I'm not here to sell you guys real estate, right? You guys are already believing in real estate. So real estate investing 101. Now, here's the reality. I've talked to so many people and they say, John, I want to invest in real estate. I say, great. Where do you own right now? And they say, I don't own. I'm like, okay. So you always get better terms and better rates if it's for your primary residence. Okay, so we're going to talk about that later. The best real estate investment you can make is buying your first house, right? And then if you bought your first house, because you can get lower down payment when you go to buy for investment properties, the banks require, it's not optional, it's a requirement, 20 to 25% down. Right now they're leaning more towards 25%, and you have to have a reserve account as well. right? So it's even more cash. So if you're just looking at a simple, hey, what's the barrier for entry? It's much easier to get in for your primary residence. Get in there, get your foot in the door, right? Like this is like the best analogy I have for this is getting on a train, right? The train's moving, the real estate train is moving in front of you, right? It's going really fast. Now, the hardest part is for you just to get on that car, get on the train, right? Because the train's moving. But once you're on the train, it's so much easier to go from car to car, right? From house to house. So if you currently do not own a home, you have to buy your first home before you start doing this. Okay, does that make sense, you guys?
Yep.
Cool. Expectations. Just want to be crystal clear. This is not a get rich quick scheme. Okay. If anybody paints this as a get rich quick scheme, they are selling you a course, they're selling you something to take your money. Okay. But this is not a get rich quick scheme. This takes a lot of time. Okay. So when you go to start real estate investing, you got to pick your market. Like there's a couple things we got to pick. Okay. First is appreciation versus cash flow. Okay. So, Katie, you might have experienced this because you've kind of moved around a little bit, right? But as an overly simplistic way, you've got appreciation markets and cash flow markets. So what a cash flow market would be, it would be like Baltimore or Hagerstown, Maryland. Okay. Like if you go to buy in Baltimore, you'll buy a townhouse for call it $100,000. Now you'll do really well in the cash flow, but guess what? In 10 years, it's going to be worth maybe $110,000 because they just do not appreciate. Okay. On the other side, you've got appreciation markets, and that would be like DC, Northern Virginia, Maryland, in the around the Beltway, right? Richmond, so on and so forth. Now you have like different levels of it, but appreciation markets are where they don't cash flow heavy. Right. So you're not going to do as well on the cash flow, but your appreciation, you're gonna win big time. Okay. Now there's no right or wrong. I know investors that have done well in both markets. But when I study guys that are way far and above, more people lean towards the appreciation markets. Cash flow markets are great, but again, where you make your money is in the appreciation, and you can do cash out refinances, which we'll talk about, right? A whole lot of benefits to it. Now, the next part is you got to understand what your buy box is, okay, right? So it meaning like, are you looking for condos, townhomes, single families, and then what price point? Okay, so price point would be, some people only deal in the luxury market. Okay, they only want to deal luxury. You have other people that are right in the middle of the market, right? So that would be for townhouses, that would be probably $500 to $700,000 for townhouse. If it's single family, it's probably I'd say, depending on where, 700 to $1 million. Okay, and then you have condos. If you go to look at what's best, in my opinion, I would go townhouses, 3 bedroom, 2 bath, 4 bedroom, 3 bath, right? In the 5 to 700,000. You can't go wrong if you're in Loudoun, Fairfax, or Prince William. Now, each county here has different rates, right? So sometimes you get it's all different, right? So again, you got to understand what your buy box is and where you feel comfortable. And I personally like being in the middle of the market because again, you have a lot of our tenants are here, right? Teachers, firefighters, police officers, like that is, kind of again like medium, and so you'll never have problems finding good quality tenants. Okay, and then of course you got investors that only deal in like Section 8, like government subsidized housing, right? And again, you can't go wrong. It's just what's your buy box going to be, right? Okay. Now there's 3 ways to make money on a real estate transaction. Okay. Now the first one is you got to find the property. Okay. The second one is you got to bring the money, and the third is you got to bring the experience. Okay. So for a lot of people starting out, you don't have either, and that's okay. That's kind of why I do this, is to educate people to get them feel more comfortable, right? Because buying an investment property, if you've ever bought a house before, you had to go look at a bunch of houses before you actually pull the trigger on that one house, right? Same thing for investment properties. I'll send people investment properties sometimes, and I just sent a guy, 2 weeks ago, Stafford County, I'm sorry, Spotsylvania down in Stafford, and he was like totally turned off because it was way more than what he thought. And that tenant that was there was just not his ideal tenant, right? And I was like, hey, it's just like you buying a house for the first time. You're gonna have to see a bunch and you're gonna have to run a bunch of numbers on the different scenarios to get comfortable, right? But again, you gotta find the property, you gotta find the money, and you gotta bring the experience, okay? So there's three ways to make money on a real estate transaction. All right. Now, I've kind of broken this up because I'm not exactly sure. Actually, let's get some quick feedback. So I know you've owned before,
Yeah,
right?
still, yeah.
You still own?
Yeah.
Have you had more than one property, or is it just the one?
So my second house I bought.
Your second, okay. Your first one, did you guys keep that as a rental, or did you sell it?
Sold.
You sold it, okay. Who else? Like, what kind of experience you guys have? I know Katie, you said you kind of moved around and you sold. Maury, what about you? Maury, you there?
Hey John, sorry. Can you please repeat the question again?
Are you snoozing on me?
No, no, no.
I'm kidding. I'm teasing you. I said, what kind of experience level? Like, is this going to be your first home? Have you bought several before? Um,
No, I'm right now we own one a townhouse in Chantilly, and we're basically just trying to see. I guess we're kind of in the middle of figuring out what the next step is going to be because we're not sure if we really quite want to sell this house or we want to use the equity on this and just move on to something else.
awesome.
That's just kind of where we are now.
Yeah, yeah. No, I love it. I love it. Does anybody here have more than one property? Anybody? Man, tough crowd, tough crowd. So the way I broke up tonight, okay, I've got level one and then I've got level two. Okay, level one is more so like, hey, at the beginning, right, kind of get your feet wet, build up your experience. Level two is, wait for it, next level. Okay, that's when things, kind of open up. You've got way more options, right? But I don't recommend starting at level two because you're gonna have to, get comfortable first, right? So how to find properties level one, really easy. Get on the MLS and work with real estate agents, right? And you should be able to find a good real estate agent that knows how to bring, either investment opportunities or other properties that are both on the market and off the market, right? So you should be able to, you'll definitely be able to find a property there, 100%. Okay. Now, level two is where things start getting complicated. Well, I say complicated, but again, level two. That's where you have MLS, real estate agents, finding properties that have tax liens. Okay, there's so many online companies, like List Source, for example, where you can go onto List Source and you can put your buy box criteria up on List Source, and you can narrow it down. You find a bunch of people and you export it and you pay them, and you literally generate a list for people who have tax liens. Okay, so you can very easily target people that have tax liens. You can do what we call like driving for dollars. So a lot of real estate investors will teach us, and they'll just say, hey, go pick your buy box, pick your neighborhood, and just drive around for like the ugly house, right? And then target that ugly house. Okay. Now, again, this is more so for like more experienced people, right? You got foreclosures, they do this online and at the county courthouse where you go physically in person. They require cashier's check right then and there. And then you got 24 hours to give the whole deposit, right? And then real estate investors or wholesalers are a phenomenal way to find properties. I've gotten a couple from other investors that I know. They say, John, I don't want this one, or it's not in my buy box. Maybe you can have good luck with it, so on and so forth. Direct mail, right? So that if you accompany or if you mix that with your buy box, right? And you're a little bit more proactive in targeting for driving for dollars or tax liens, that's a great method. I know people that do incredibly well. There's pay per lead companies out there. So if you just Google pay per lead real estate companies, you'll find places where you can buy leads online on pay per lead. And then you can also do pay per click. Okay, so pay per click is more so, paper lead is good. But you're kind of getting people where they're not even thinking about investing in real estate, right? And you're kind of getting them on a whim, right? Now, pay-per-click is totally different. Now, I just got into pay-per-click a while ago. And that's where you have people reaching out to you saying, hey, I want a cash offer on my house. Okay. Now, whether it fits your buy box or not, that's a totally different subject. But that's again, next level. To where a lot of guys I know, they're spending 5, 10, 15 grand a month just on pay-per-click leads themselves. Right. So again, this is like level 2 real estate investing to where like you're looking to scale it up. But you don't, I certainly wouldn't start there. Right. Again, I would start with real estate agent MLS, because any quality agent should be able to help you walk you through that. Okay. So again, guys, I want to tie this in there. So how I personally found my first few properties. Now, number one, I found it on the MLS. Okay. Shocker. Yeah, the second one was a real estate agent friend of mine who said, hey, and not every real estate agent does this, right? Like they don't deal in the investment space. They're not familiar with it. And so he said, hey, John, here's a property. It needs a lot of work. Do you want to buy it? Okay. And I bought that one. And then another one came from another buddy of mine who was like, hey, I'm slammed right now. Do you want this? And so I bought it and I paid him a fee, right? And I'm happy to do that, right? As should you, because they're basically giving you, it's like, hey, Merry Christmas.
Right.
Here's a house, right? And then where I found that others mine are sellers in my pipeline, right? Sellers I'm just talking to. And I talk anywhere between, I meet with anywhere between like 20 and 30 sellers a month. And so sometimes I'll get sellers that say, John, I hate realtors, right? Like you guys in your 6% or whatever it is. It's funny, I had one that was like, John, I hate realtors. I don't want to pay 6%. I'll sell it for, 354. And I was like, you know what, sir? I will buy it from you for 354. It was worth like 600,000, but he saved on his 6%. He saved on his 6%. So everybody's different, right? So it also so that's kind of how you find properties. Okay. Now finding it is kind of half the battle sometimes, right? But the second part is probably more important. Okay. So again, we've got financing strategies, we've got level 1 and we've got level 2. So again, I said for all you guys, it's always easier to buy properties if it's your primary residence, meaning you have every intention of staying there for the next year, 2 years. Okay. Now that's what I did on my own first one. And then I can't do that now because my wife's like, you're crazy, right? Like, where are we gonna move? Right. But conventional loans, very easy. I mean, you can put 3% down, 5% down, 10% down. Like you don't have to put a lot of cash down to be able to do that, right? So it's always easier, you guys, to buy as your primary residence, live there for a couple of years, and then take that property that you're currently living in and rent it out, assuming the new rent payment covers your existing mortgage, and you can qualify having that debt. Okay, so talking to a lender is incredibly important right there. Okay. Along with that, it's going to be FHA and VA loans. Now, you cannot buy an investment property with an FHA or VA loan. It's only primary residence. Okay. So utilize the FHA and VA loans for your primary residence. Now, what most people end up doing is they'll go get an investment loan. Okay. So they'll put 20 to 25% down on the house. So let's say, for example, you bought a rental property for 400,000 and you put 25% down. Now, in this one, you would have zero intention of living in the house. Okay. So that's why I said buy a property for your primary residence, because the barrier for entry is so low. Sometimes it's hard to come up with 25,000, or I'm sorry, 25%, right? So on a 400,000 house, that's what, 125,000, right? It's a lot of money. Now, where to find that money? Here's how you kind of think outside the box. If you currently own a property, you can go to, and I have places listed on the screen. You can go to PenFed Credit Union, Apple Federal, or Tower Federal Credit Union. They can give you lines of credit on your house at the prime rate +1. Okay, that's about what they're offering. So right now, I think prime rate's 7.5. Right? So you're borrowing your equity, which you're not using anyways, at 8.5%, right? Which is honestly not a bad deal. And some of these will allow you to bring up 90%, 100% of the loan's value. Okay, so just don't be silly with it, right? Be smart, don't over leverage yourself. But that's a phenomenal way to be able to pull resources for a down payment on the next house. And so you can either do that on your next primary house, or you can do that on an investment property. Okay. You can also borrow from your 401k. So all you have to do is call them, have a conversation and say, hey, what would it look like for me to borrow these funds? Like what's the rate gonna be? What are the fees? And just have a conversation. Most times you can just very easily borrow from it or borrow against it, okay? And the other one is friend or family member, okay? They are incredibly helpful.
Hey, John, quick question.
Yeah, go for it.
If you take a HELOC, and does it have any impact on if you were to go buy your next property other than
It does, yeah, because it's gonna show up in your debt to income ratio.
right? But other than
Yeah,
that, no other.
but other than that, no. I mean, you just want to make sure that the cost of the HELOC, right, is going to, like, whatever that money that you have to pay for, like whatever that monthly payment is.
Mhm.
When you factor in the next house, what the rent's gonna be, or if you take it from it, can your existing rent cover it?
Right. Okay.
So whenever you're doing this, right, and you own a house and you want to go buy another one, it's always good to chat with a loan officer before you get too into the weeds to figure out, hey, what are my options? What do I need to do? Because sometimes it's hard to keep a house and then buy another one, because that house, let's say that just for easy numbers, let's say you get $2,000 a month in rent, okay? And let's say your mortgage is 2 grand, just for easy numbers, okay? The way that the bank looks at that is they're gonna say, you know what, on paper, it's a break even, but from our eyes, you're at a loss. They only account 75% of that gross rent
Mhm.
as income, because they factor in repair, vacancies, maintenance, like, all that stuff. So if your mortgage is 2 grand, you're on paper, you're losing $500 a month in the eyes of a bank. So that's why it's harder to keep property and buy it. That's typically what holds people back. So you either need more money, right? You gotta save more for a down payment, or you just buy a cheaper house.
Nah, more money.
I love it. I love it.
Thanks, John.
Yeah. Any other questions? This is a small group, you guys. I think there's only like 9 or 10 of you guys. So happy to, answer any other questions as we go through this. Okay. All right, level 2. This is where it kind of gets fun, right? A DSCR loan, hard money, private lending, and then creative finance. Okay, I'm gonna walk you guys through each and every one of these topics. All right. So a DSCR loan, it's a debt service coverage ratio loan. Actually, throw something in the chat. Are you guys looking to buy an investment property outright 100%, or would you guys go to buy a primary residence and then rent out your current one? I'm just kind of curious who we have in the audience, like what you guys are hoping to do. I guess, Steve, if you bought one, would you?
If I bought another property,
Yeah.
I'd probably try to rent out my property. It's in a pretty good location, right? So
Yeah.
my property right now is downtown Percival. And
Oh,
I'm
nice.
grandfathered into the historic district.
Oh, nice.
I have like a half acre, no HOAs.
Yeah.
Stuff like that.
Yeah. Oh, that's great. See, a lot of people right now, that honestly, that's the play right now, is to keep your house, because a lot of people also, if you look at the debt that you have on the house, like
Right.
everybody's got low interest rates, so like why sell that to go get something higher? So yeah, that's more, a lot of people are doing that right now.
Right.
Yeah. But there comes a point to where you can't do that anymore, because the amount of debt that you have, you go to any lender and they say, you got too much debt, right? Like and you just can't get a loan anymore, right? So you gotta be careful when you kind of get up there. But there's debt service coverage ratio loans, which basically doesn't factor into what you make at all. Like they don't look at any tax returns, they don't look at pay stubs. The only qualification they have is the rental income from the property and your credit score. That's it. They don't care about tax liens, they don't care about IRS debt, they don't care about credit card debt. I mean, they just look at your credit score, but how they evaluate that, it's 0.8 to 1. It's like a ratio of 80 to 100% of the rental income. So for example, if you buy a townhouse and let's say it rents for $3,500 a month, they're gonna wanna make sure that your mortgage, the debt that you have it is no more than $3,500 a month, so it's a break even,
Gotcha.
right? Some lenders go above that and they allow for you to take a loss. I would say be hesitant on anything like that, right? Because you always want it to cash flow. The real estate market goes up and down, right? Prices go up and down, but rents typically never go down. If you look at like a 70-year average, rents almost never go down. Okay, so always want to make sure you're cash flowing, always. Now the max LTV is loan to value ratio on those, typically 75%. Some of them can go up to 80%, but they want to make sure that you got skin in the game, you got equity. Okay. So that's debt, that's DSCR loans, really common. Next one is hard money. Okay, so if you buy a property, you're gonna be at 2 to 3 points and anywhere between 12 and 14%. Okay, now that's dependent upon experience, down payment, like how much skin you have in the game, because it's what the lender is doing. And you have bigger organizations and you have small guys that do this, like one-man shows, guys that are at 70, 80 years old, and they're just sitting on a bunch of money and that's all they do. They just lend it out, right? So if you have little experience or little money, it's a higher risk to them, and so they're gonna just charge you more. Okay, so again, this typically isn't for people that are getting started in real estate investing. This is typically for people that have a handful of properties underneath their belt and they want to scale at faster pace, right? Because you're gonna get to a point, right, where it's like, if you're buying 4 a year, it's really hard to put $100,000 down on every single one. And I would actually argue to say it's probably not smart, right? Because that's a lot of cash that you're tying up in each property, right? So the way I evaluate and the way I, kind of advise people is try to put down as little of your own money as you can. And I'll give you guys real world scenarios on my own, right? Again, speaking from experience on return on investment, down payments, just so you guys can get a better idea on that. All right. So that's hard money. And then seller financing. Okay. This is where you buy the property and the seller acts as a bank and holds the note. Okay. To a loan officer and getting the funds. You just give the seller a down payment and he holds a note. And so you can negotiate the rate and the term of that note. So it's pretty cool. So the purchaser makes the monthly payments. The only thing you need is an attorney to draft the promissory note, which is the IOU, is the deed of trust, right? That you got to sign. Okay. Any questions on seller financing?
Yeah, wait, can you explain that one more time?
Yeah. So that would be, let's say that you buy a property from me. Okay.
Mm-hmm.
But let's say that you were able to negotiate me to be the bank. Okay. So what you would do at the time of settlement, as opposed to going to somebody else to getting money, okay, let's say it's $100,000.
Mm.
You give me $20,000 today, and then you would me payments at a rate and over a term period of time that we agreed on.
Gotcha.
So with seller finance, you can typically get rates better than the market.
Awesome. Okay. Thank you. And then I don't know if you want to go back now or after you finish this slide, but the one right before this, where's it was 75%. I think I missed that or the mic went out for me. What was that?
Is a
The
debt
max
service.
LTV.
Yeah, max loan to value is 75%. Some go up to 80%. It just depends on experience, credit score, and which lender you're talking to.
Okay.
But typically it's 75% is typically the cutoff for a lot of people.
Gotcha. Okay. Thank you.
Yeah. So fun fact, I just did my first seller financing today.
Ooh.
So that was a fun one. I'll tell you guys about that here in a bit. All right, assumptions. So these have become increasingly popular in the last couple of years because if you were to go get a current loan right now, your rate is, on the investment side, 8.5%. Or low sixes right now for primary residence, but you can assume a current owner's mortgage, which is basically where the loan is in their name. So let's say I bought Steve's house, okay? So Steve, you're making a payment. Let's say you bought it in 2015. Okay, you're at 5% rate, whatever. You're 10 years into that mortgage.
Right.
Okay. Now FHA and VA are both assumable. Okay. So I can assume your mortgage. I have to go through your servicer, right? So whether you have Navy Federal, Penny Mac, Mr. Cooper, whoever it is, I go through your servicer. I qualify for your loan, meaning that I can make the payment just like you normally would. And I take over where you are in the life of the loan. It may not seem like a big deal, but you are 10 years into a 30-year amortization schedule. The first 7 to 10 are heavy interest payments. If you guys ever look at your statements, your principal goes up by like $3 every month, right? So saving 10 years is a big, big, big deal. So it's a huge advantage, huge advantage. And so you just have to go through their current service provider, and it can take anywhere between 30 and 60 days. During COVID, it was taking like 90 because everybody was backed up trying to do this. Or like post-COVID when they shot up, to 7%. But it's a massive advantage. Okay. Now, again, you can do that with FHA and VA loans. VA loans, it's tricky, okay, because the seller on that VA loan, if they assign it or assume it, or if they let another military person assume it, they freeze up their eligibility on that. Okay, because every veteran has a certain amount of eligibility. They can assume it to a citizen or civilian can assume a VA loan, but the seller would not give up their eligibility. Like their eligibility would stay on that property. So typically, VAs, you see a lot of veterans assuming VA loans, but it is possible for a civilian to assume a VA loan.
What's the benefit, John, for the seller in those?
Sometimes they can get a higher price.
Okay.
Because you say, hey, I'm 10 years in, my payment's 25. If you go anywhere else, you're at 45. So
Mhm.
it's a big, big savings to that buyer. So typically they're willing to spend a little bit more.
Okay.
Yeah. Subject twos. Okay, so this is more of a niche market. Okay. Now, in the assumption that loan goes out of the seller's name into the buyer's name. When you hear subject to, it's you're taking title subject to an existing mortgage, meaning subject to existing debt that's on the property. The mortgage would stay in the previous owner's name. Okay. It also stays on their credit report. So there has to be a lot of trust, but you would continue making payments on their mortgage, and it's going to show up on their credit report. Okay. You have to be careful because if their loan servicer finds out there's a due on sale clause that gets enacted, and you could be forced to pay the full remainder of that loan in 30 days if they find out. Okay, it's totally legal, right? But if somebody if a bank servicer has a loan for 2.5%, and then all of a sudden they find out, oh, they don't own it anymore. Somebody else owns it and they're making payments. Well, it's like they want that 2.5% gone, right? They want it off their books. They want to go give out money at a higher rate. So you have to be careful. You got to do these a very specific way. It is it's a phenomenal tool and asset. Okay. If you can't qualify like on the VA and FHA, you can do this. Okay, so it's a little bit more creative. So the advantage right now is that you can get much lower rates, much cheaper money on subject twos and assumptions. Okay. The downside is that the amount of money required to take over these loans every year, guess what? More and more and more. right? So we took over some assumptions years ago and it was very little money into it. Nowadays, it's very common to see 100, 150, $200,000, right? So kind of the only way that you're able to take it over, most people, is if either you have a, HELOC on your existing house that you borrow against, or you sell your property, right? Because that's typically the two ways that I'm seeing people, unless they're just like, coming from oil, and they just got deep pockets. Okay. Any questions on subject two? Most people won't come across them because it's a very, very niche market. Okay. But it is an option out there and it's very, 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 very creative. But everybody always asks me if it's legal. Like, yes, it's legal, 100%. Okay, how to write contracts. So for a majority of you guys, if you're seeing anything on the market, just use your standard realtor contracts. Okay. When you start to build up your portfolio and you're doing off-market properties, and off-market acquisitions, you need to dumb it down. Okay, because some people, that contract is going to scare them off. Because they're gonna say, oh my gosh, the reason I'm selling this is for the convenience. Like I'm willing to take less, but oh my gosh, like the headache and hassle, like you have all these acknowledgments and disclosures. I don't want all that, right? Like give me a simple contract. That's where you have to have a 1-2 page contract with very limited, very boilerplate, very simple, or else you're just gonna scare people off. Okay. But if it's anything on market, just use your standard realtor contracts and you will be good to go. They're kind of expecting that. Okay. Legal structure. Okay. For most of you guys, when you buy a house, you're probably going to keep it in your name. Okay. The problem is if you change it to an LLC, the bank could get triggered that somebody else bought the property and enact a due on sale clause. Okay, so you just have to be careful in how you structure it. So seek legal advice when transferring it from your own name into an LLC. But the general rule of thumb is when you start building out properties, every property has one LLC, one bank account. I learned this through my attorney because he said if you have multiple one LLC for 2, 3, 4 properties, however many it is, and somebody sues you on one of them, they can come after the assets, everything in that LLC. Okay, so it is expensive to maintain it because each LLC is $100 in it for an annual fee, the state of Virginia. But to keep it separate, also have one bank account per property. Because if you commingle funds, the protection that the LLC provides gets pierced if you commingle funds. Okay, now that's directly from my attorney's mouth. So now it's every property I buy, separate LLC, separate bank account. I don't even think about it, right? We just do that. Now some people ask me, hey, John, when I'm buying an investment property, I want to put it in an LLC. Well, doesn't always work like that. Okay, especially if you're using your own income to qualify. If you're doing an investment loan, it has to be in your name because your LLC probably doesn't have any income. Right, because you're just starting it for like real estate investing. So if you just look at the structure of your LLC, you got no income coming in. Right, so it's 99% of the time it goes in your own personal name. Okay, so that's just the easiest way to structure it. But when you start building it up, that's when you need to chat with an attorney about structuring it, like create a holding company and then create all your other LLCs, below it, put it to a living trust. I mean, this is like level 3 and 4 stuff, right? But I would recommend when you start buying property to get a trust. Do you guys know the difference between a will and a trust? Fun fact, anybody? No? Anybody? It's like pop quiz now. No? Okay. A will, you have to go through probate. So what probate is it's going through the courts. And they put it in the paper, so they say, hey, if anybody has debts, come now, and let's clear the debts on the estate from the money and from the assets. So your will actually makes things public And it has to be approved through the courts, which can take 6 months, a year, 2 years, depending on what's all involved, okay? And then you could have other people coming, oh, I'm the long lost cousin, whatever it is, right? A trust, however, everything stays private. It doesn't have to be approved through the courts, and whoever is the trustee makes decisions right away. So if you want, like some of you guys were talking about, hey, I want to set this up generationally for my kids, I want to do, leave a legacy for them. By you setting up your trust, you would effectively be taking that one direction, the one step to make sure that your kids are taken care of. Okay. So it's a big, as soon as I learned that, I was like, oh my gosh. So everything I do now, I put in the trust to take care of my kids. Right. So I've got a phenomenal trust guy. If anybody ever needs it, I'll leave something at the end for you guys to reach out to me on. All right, we're moving on. We're moving and grooving. All right. Tax benefits, level 1. You get depreciation. Okay, so you get to deduct the cost of the property, not the land. Okay, so if you guys ever look online and you see, let's say you see a house, for townhouse for 500,000. Okay. Well, the building's probably gonna be worth taxable, maybe like 350, 400, something like that. And the land will be 100 or 150. Okay. You can only deduct the 350 or the 400. Okay. Now you use that on a depreciation schedule, and you just do that over 27 and a half years. So, just for easy math, okay, let's say you bought something and its tax assessed was 270,000, 275,000, right? That means that you can deduct 10,000 every single year over the next 27 and a half years. Make sense?
Yeah.
So the more properties you have, the more this really adds up, okay? So it reduces the taxable income, even though your property's cash flowing, okay? And then you can also do cost, like bonus, which is a cost segregation, which allows accelerated depreciation. So you can do a cost segregation study and front load that into year 1. So you can take all the 27 and a half years, all that 275, and front load it year 1. Okay, so if you have a special designation, which is on the next slide, you can really offset your taxes. That's why I see a lot of people in real estate investing. So depreciation, number 1. Number 2, mortgage interest deduction. So you can deduct all the interest paid on the mortgages for investment properties, right? So that helps reduce it. And then repairs and operating expenses. So you deduct all property taxes paid on the rentals or investment properties. You can't do this with your primary residence. Okay. So anything for repairs and operating expenses. This is level 1. Okay. Now here's level 2. When you start building up a portfolio, you can do what's called a 1031 exchange. So like, let's say you bought a house for 350 and now it's worth 800, just for easy numbers, right? Or let's say you bought it for 800, because that would be easy numbers. So you have $400,000 worth of equity. Now you can take that equity, sell it, do what's called a 1031 exchange, and roll it into 2, 3, or 4 properties that make other returns and spread your money out and grow your portfolio. Very common. And so you kick the can down the road by reinvesting the proceeds into another like kind property. I've got a bunch of people I'm doing it for right now. It's a massive benefit, okay, because it allows you to scale and grow your portfolio. Okay. Capital gains tax treatment. So you can pay longer term capital gains if you hold it for over 1 year. Okay. So you don't pay short-term capital gains, you pay longer term, which is much better. Okay. It's just based on where your tax bracket is. And then if you are a real estate professional status, so if you work 750 hours in real estate and 50% of your time in real estate, it allows those passive losses. So if you do a bonus cost segregation, it's phenomenal for high income earners. Okay. So that's kind of like level 2. Right, when you start building it out, maybe you're like, hey, you know what, let me walk away from my job and step in real estate. There's additional tax benefits for you. And then you guys talked legacy, generational wealth, right? Step up basis. So when you die, your heirs receive a step up in cost basis to the market value, meaning they don't have to pay capital gains on it. So there's massive tax benefits for that. Okay, and now that's regardless if you had it in a will or a trust. It's regardless, that's just tax law. Okay. All right, insurance. Insurance is totally different, you guys, okay? You've got homeowners insurance and landlord. So if you own a home, your homeowners insurance policy covers all the contents in your home along with the structure of your home. Okay. Now, what happens when you move out into the next house? You don't have any more contents in the house, right? So you can actually downgrade your insurance policy to a landlord's insurance. So typically, homeowners insurance here would be like, I mean, the rates have been skyrocketing, right? So I mean, you're talking 2,500, maybe $3,000 a year. Okay. Landlord insurance would be like $800 a year.
Gotcha.
So it helps significantly on your cash flow. Okay, so it makes all the numbers that much better. Okay, so I put my insurance agent's information right there, and I'll include every one of my team, their information at the very end. Okay, another thing about insurance, when you start building it up, and I didn't know this again until I started getting into it, you have what's called an umbrella policy. Okay, what an umbrella policy is it's a catch-all. Okay, so there's 1 million, 2 million, $5 million umbrella policies out there, which basically means that if you get in an accident, somebody sues you, okay? I think they're like $300 a year, $300 or $500 a year. If somebody, let's say, you're at your house and you have like a bunch of kids over, somebody birthday party, somebody breaks their skull, right? And they sue you. Your umbrella policy would basically take care of it up to $1 million or whatever the coverage is. So honestly, the more assets you guys have, you need to look at making sure that you're protected on that side. It's not on the slide, but that's a learning lesson for me. Okay. And then you've got property management. I'm not gonna dive too much into it, but if you want to, I always tell people, hey, try to do this on your own if you want, right? A lot of people think it's really easy, and sometimes you can totally luck out, right? You can get like the nicest tenants in the world. I will tell you, I've had more evictions, unfortunately, in the last like 12 months than I have in the last, however long. Just due to the current economy and everything. So my general rule of thumb, you guys, okay, and you see this a lot out there. 3 times the income per rent, meaning if you have a property for rent, let's again, easy numbers, call it $3,000 a month. Okay. I want that tenant to be making between two people at least $9,000 gross a month or more. Why is that? I want to make sure that if something happens, like they're comfortable, they're not scraping by, they're not, month to month, paycheck to paycheck, like scraping by. So if their alternator on their car goes out, they can still afford to live here, right? So it's a protection tool. It's a really quick rule of thumb to protect the tenants and to make sure you got a good quality tenant to hopefully eliminate the need for an eviction down the road. Now, obviously, things happen. I like to see 680 or above, but I've rented to people much less than that. Sometimes you got to give somebody a handout, but you just ask for more in security deposit just in case they don't pay. They kind of have more skin in the game. Okay. Now, property management fees are anywhere between 8 and 10% of monthly rent. Alex West, they've got Rent Virginia. I think they're at 8%. So on the lower side. So, and we can help you guys find the tenant and then do the lease, and then they can manage it for you. Okay. I'm not going to spend too much time on that. All right. This is the fun part. Okay. I'm going to walk you guys through 2 properties that I personally bought. Okay. And I'm gonna walk you guys through the numbers. And I've actually updated the numbers since then, okay, because it's been a while since I've updated this slide. Okay, so this is the first house I bought. Don't go there, I'm not living there, okay? I rented out, so I bought it in 2015 for $415,000. I got an FHA loan. I still have an FHA loan on it, so I'm still paying mortgage insurance, but the numbers make sense, you guys. So we moved out in 2019, okay, and I rented it out for $2,750 per month. So I was literally like breaking even, okay? Because my rent or my mortgage plus the HOA is $2,750, so I rented out for that. In 2021, I increased it to $2,900, so I started making $150 a month. Woo woo, right? but I'm not paying for my kids' college on that. And so in 2024, my mortgage principal balance was 311,000. Okay. I increased the rent to 3,200. And I just actually this month, I haven't updated the slide. Rent went up again to 3,400, right? So I'm even better than that. My property value now is at 650, 660. And now I cash flow like $700 a month. And I think I have like $320,000 worth of equity right now.
Right.
Now, the cool thing about this, you guys, we talked at the very beginning, primary residence versus investment, right? I did 3.5% down and I got the seller to pay all my closing costs. Okay. So I was only in $15,000. Okay. And even if you look at my rates from 2 years ago, I'm making 6,000 a year and I've got $217,000 worth of equity. Now it's more now, right? But my ROI, you guys, look at that. 17 times.
Right.
And the reason is because I didn't put as much down, right? Because obviously the more you put down, the higher you're gonna have to earn.
Yeah.
Right. That's why I'm a big proponent, if you can, as little money as down as you can. Because even if you're making like a break even at zero money down, that's amazing. That's phenomenal. Right. So I just want you guys to notice this ROI at 17 times. Okay. Now, here's another one. Now I did a subject to this thing that you guys were like, what the heck is this? Now I did it before it was a thing. I don't want to say I'm like cool or anything, but what was nice is I did it back then. So when it started happening now, I was like, oh, I know this stuff, right? I wasn't like learning it then. So here's the property address. It's in Herndon. It's a cute 2-level house. It's like 2 bedroom, 1.5 bath. I took it over subject to the existing mortgage for 162,000. Now, when I took it over, rates in the marketplace were 3%. It was like 3.5%. So I actually debated. I was like, man, this one's at 5.5. What should I do? Well, guess what? That loan, he got it in 2008. So he's about 12 years into the loan. So we already passed like all the heavy interest payments and sort of forth. So when I took it over, the PITI plus HOA was 1630. I rented it for 1850, so I only made like $200 a month. Okay, well, it wasn't anything to jump and scream about. Now in 2023, my principal was 198,000. Okay, now I think it's closer to like 100. It's like 105. And the rent in 2023 was 2150. Okay, that which by the way, now the rent's like 2,600, which is insane, total insane. Property value 420. So on that property where I put like 80 grand or 60 grand down, okay, I cash flowed $500 a month and I have $280,000. So if you look at the ROI, you guys, look at that. Only 3.6 times. Right? And the numbers are about the same to my townhouse, and that's why I kind of use this as an illustration, is because I put less money down.
Right.
So now when I evaluate deal for myself or for my clients, right? It's like sometimes they say, well, John, what's the best way to structure it? Okay. And I'm a firm believer in as little money as you can down, that you can afford the monthly payment, right? Because you're going to be stuck with that. So put as little money down as you can afford that feels good to you. Now everybody's got different thresholds. I just helped a guy buy a house. It's new construction. He does really well. It's like 950 or something in Maryland. And because he does really well, I was like, hey, after you do this, like, let me go help you buy investment properties. And he goes, John, I want to wait a year because I want to pay off my mortgage in a year, and then I'll start buying. And in my head, I'm like, oh my gosh, the math, right? Like, even if you have 7%, like we could buy 4 or 5 properties. But for him, he's more focused on peace of mind, right? He just doesn't want any debt over his current house, right? So everybody's different. Everybody's got different comfort levels or security. All of that. So everybody's different. Okay. All right. So Maury said, how do you calculate your ROI? Do you have a formula? It's just money in versus money out. Super easy. So, hold on, let me go back here. Okay. So money in 60 grand. And then my ROI was 6 grand a year, so 24 grand over 4 years, plus 280. Right? So if you do that math, and then you just do like some easy division there, and it's about 3.6 times. Okay. Or somebody fact check me. I think it's about 3.6. But it's just money in versus money out, right? That's it. Now, how to analyze the deal? Purchase price, rental income, expenses, cash flow, and then ROI. Some people get big on cash flow, right? They want to say, oh, I want X number of dollars a month. It depends on the market. If we're here in Northern Virginia, a lot of you guys, if you're currently in a house and you want to go buy another one, I mean, you have to look at this differently. You got to say, well, what am I going to make on my house, right? How much is that going to be? And then what's the mortgage on the new house going to be? And typically, even with rates higher, like you can do really well renting your own current house out, but it just depends. So, purchase price, rental income, right? I look at everything, all the factors. And so for some of you guys looking to buy a next house and rent it out, you want to look at, hey, what can you rent yours out for? Right? When you start to look at those numbers. Now, when you look at expenses, guys, it's really easy to do which are PITI is principal, interest, taxes and insurance, okay? So principal and interest, if you just Google online, loan amortization calculator, okay? There's hundreds of them online. Play around with it, play around with the loan amount, play around with the, and type in 30-year fixed, and I would do like a 6.5% interest rate. You could get a little bit less, but just use that for easy numbers, right? But the thing that those online calculators do not have are taxes and insurance. Okay. So taxes are going to be about 1% of the purchase price if you're anywhere here in Northern Virginia. And then insurance, I mean, it kind of depends on how big of a house, but I would ballpark like 3 grand a month. I'm sorry, 3 grand a year for insurance. And if it's a little bit more, a little bit less, it is what it is. But that's kind of how I analyze the deal. And again, I always look at, hey, how can I put in as little money as I can? Okay. Now, switching gears here. Question for you guys. How much do you guys think it costs to renovate an entire condo? So I've got an illustration here. 3-bedroom, 2-bathroom condo that's 1,500 square feet. How much do you guys think? Steve, what do you think?
Let's go with 60,000.
60 grand. Okay. Who else? I got 60 grand. What other takers do we have? 75 grand. 45. 40. Anybody else? $35. I think you do it for a lot less. So I did it for 49 grand. Okay. I think if you were to go to a lot of bigger general contractors, I mean, you're probably paying 50-75% more than that. Right. And so it's all about having the right people. And so I literally just did this just to give you guys an example, but ripping out the kitchen was like almost $1,700. Here's the, dishwasher, material, labor only, right? Master bathroom. If you guys want to take pictures of this just for your own general knowledge, but it was a 1,500 square foot condo. Material for a kitchen, right? It's like $4,500 for labor in the master bathroom. $2,100 for material for the bathroom. Hallway bathroom is that. So I think what paralyzes a lot of people is they have no idea like kind of what to expect, especially if you go to buy another property or maybe your own, you get paralyzed because you say, oh my gosh, I don't want to deal with the work, right? So I just found a really good team that's done this, like a whole kitchen. I think we did here, I think it was like 18,000 for gutting the whole kitchen. We made it center island, like it really looked good. And then I mean there was like a bunch of other stuff on here, but I just want to use this as an illustration, okay? So here's what I wanted to bring something up. And so, we do a lot of, like I said, I probably talk to, I don't know, 20, 30, 40 homeowners a month that want to sell. And a lot of people, they say, hey, I want to sell, but I don't want to deal with the open market. I don't want to prepare the home up for sale. I don't want 30 people coming through. But John, if you have somebody, I would 100% sell it. We're listing, I got some people that are like, hey, we'll sell it next year, but if the right offer came along, we'll do it this year, right? So everybody's totally different. So I wanted to bring some for illustration. 2 bedroom, 1 bath. They're at 5.5, or I'm sorry, 5.25% FHA. So you can assume this one, okay? Wouldn't be subject to, it would be a straight up assumption. 5.25 is ridiculous. I mean, right now you're probably closer to 6%. And it only takes you about. I got a townhouse in Springfield. It's 4 bed, 3 bath. It needs some work. Those typically, and I think this one has a garage, and so this one's worth 650 fully renovated, but I just want to let it go for 550. And then I have a McMansion, 7,000 square feet in Middleburg, Virginia. It probably needs like 200 grand for work, just cosmetic work like flooring, kitchen, paint, all that stuff. But I think it's worth like 1.9 million. And that one's on 5 acres too. So I mean, you get like a whole lot of space. So that one's really nice. Okay. But I got a bunch, I probably have like 20 more. Honestly, I didn't want to go have like 5 slides going through like, hey, I got 20. So just reach out to me if you guys are interested. But so I got 2 ways to get started, okay? Because a lot of people get paralyzed, right? They're like, well, what the heck do I do? So if you want to start investing, so I got to email me, right? So email me like john@cityscapemeasure.com and just like tell me kind of what you're looking for, and we'll hop on a call and we'll figure out exactly, what your buy box is and what your goals are and where you want to be in the next 3-5 years, what you want your portfolio to look like. I've helped so many people start at zero. I started at zero. The hardest one is getting the first one right, and then it kind of like gets easier and easier and easier. But then if you're a realtor, you want to grow your income, right? So we created a brokerage here, like a brokerage within a brokerage, so we can help you grow your income, lower expenses, build your wealth, right? As it pertains to this. Now, I will tell you, a lot of realtors don't know how to speak the investment lingo, right? You have like a realtor hat, and then you have like an investor hat, right? A lot of realtors don't know how to speak that lingo. So if you want to build your business and scale it, reach out to us because we've got a phenomenal platform for that. Okay. Now here's my team. This is the dream team. Okay. So I got a CPA, Michael Westwick. He helps me with all my tax stuff. He's amazing. Okay, in case we had trouble. My lender, Brittany Aikman. Brittany is good with DSCR, like investment loans. She's great with first time home buyers, move up buyers, VA, FHA, like she's done it all. Okay, so she's great. Alex West is my property manager. All right. Manages all my properties, and others for other clients. Attorney Jason George, so he helps me and my clients stay out of jail, which is great. Okay. And then insurance, Sonia Philly, she's at Allstate. She understands all this stuff. So when you come to her and you say, hey, I've got an assumption, I've got a subject to, or if you're doing a flip, right? And we didn't even talk about flips. But if you've got a flip, there's an insurance policy. It's called builder's risk for a flip. It's much cheaper. I think it's like $300-400 for that policy, but it protects you when you go to flip it. So she understands everything in this world. So I would reach out to her. Okay. Now it is 8:18. So I wanted to open this up and give you guys like 12 minutes or however long it goes, just like Q&A. Okay. So let's see, what do you guys got? Comments, questions, thoughts? What website do you use to find the tax lien properties? There's several. I mean, again, you can go to listsource.com. And you can just buy them that way. Some counties actually publish it on their sites, and so you can go to the county's website too, and find it. So a lot of that information is public, because if they have a lien on the property, you can find that through databases. So a lot of that stuff you can just find more online. PropStream, you can search tax liens as well. Yeah, good question. What else? Oh, come on, guys, don't be easy on me. That's it?
John, I got a bunch for you, but we'll have to meet. I got
Yeah,
I got some plans.
let's do it.
Hey,
Let's
I'll
do
email
it.
you.
Yeah, email me. I'd like to see the other house you have. Uh, which other house? The other ones I bought or the other ones I have available? I said I had 20. Oh, yeah. Yeah, I got a list. I gotta go back to my computer. So I got them in, like, I got some in Spotsylvania. I got some in Fredericksburg. I got Prince William, Fairfax, Loudon, Front Royal. If you want a double wide, I got a double wides for you, manufactured homes. Yeah. Yeah, I can send them to you out there. I got you, Farrah. Who else? So let me tell you about a deal I just did, and I closed on it today. This was really interesting. Okay, so I met with this guy. So by the way, so I talked to some people and they're like, John, um, like you buy all the property, you're like, do you really send it out to people? Like, why would you do that? Right? And like, it's like the skeptic, right? I'm like, look, I can't buy every piece of property that I come across. Right. Sorry guys, I'm not a billionaire. I don't have like a slush fund, right? I can't buy every single one. Like I had a house that I ended up buying last week. I tried to give it away to people, right? It was a foreclosure, needed like a lot of cash, had a tight time frame. I actually didn't want to buy it. I tried to call everyone, I was like, can you please buy this? Right. And nobody I called wanted to buy it. I'm like, guys, come on, because I have other stuff I got going on right now, right? So I can't buy everything, so I send it out to other people I have. So if I don't know you're looking, I don't know to send it to you, right? So I just bought a foreclosure, but I bought another one today to where we talk about cash out of pocket. Okay, so most times you have to put, you know, that's why they say cash is king, right? Put in for an investment property, 20-30% down, 25% down, right? Like that a lot of times just solves a lot of problems. And it's so much easier because more sellers want to go that route. Okay. So I'd say 90% or 95% of everything that everybody's going to see is going to be that realm. Okay. So just anticipate it, expect it. Okay. I have some people that are like, John, you don't send me enough, like, subject twos. I don't even come across them that often. I mean, they're so rare nowadays because a lot of people don't want it on their credit report, right? They want to be out, they want their debt out of their name, right? They want it out. So it's the likelihood is very low, okay? But I sent it to people. So I met this seller and he was like, not what I expected. He's like, John, actually, he was talking about how good he's doing and all this stuff. And so I ended up taking over his mortgage subject to for like 168,000. Okay. I went under contract for 285. It's probably worth like 400 fully fixed up. Okay, so I bought it for 285. But I got him the difference between 285 and what's it, 168. I got him to seller finance 87,000 to me at 6% over 3 years. Okay. Now it's funny, I was talking to another agent about this, another realtor, and he was like, well, and he's like the skeptic kind, right? And he was like, well, that means like, what does that mean? It means you have to write him a check in 3 years. So I was like, yes, absolutely, I do. But if I can borrow money at 6% for 3 years, like I'll figure it out. You know what I mean? Like it buys me 3 years to find 87 grand somewhere, somehow, somewhere. Or worst case, I just go to family or friends and I do another deal with them. Right? So when you have a property that you really like, um, you can always figure out the finances, right? Like I've got another guy that I helped him do a 1031 exchange. He sold a townhouse that he was in. He really wanted to get out of it. And he just wanted to start buying and building houses, right? So I helped him sell his property. We did a 1031 exchange. We tax deferred any capital gains. I helped him buy a lot in Fairfax for like 750. And then he's gonna build on it. Well, he's having problems getting funding from banks because it's his first one. Okay. Now, him working with an experienced realtor in the space helped, but a lot of banks and lenders are hesitant to give a lot of money. I mean, this would be like it's gonna be like a $2.2 million house that he wants to build, right? So a lot of people are hesitant to give that kind of money to somebody if it's their first big one, right? So long story short, worked with him, he got creative, ended up pulling a HELOC on his house where he's got significant, I mean, he owns an Ashburn, it's worth like, 1.8 and he only owes like 500,000 on it. So he's getting a significant amount of money from his current house, right? And that helps a lot, like a lot of his problems go away. Right. So sometimes when you have a property and you're like, I want to make this happen, it just takes a little bit of creative way for us to get around it. Sometimes we get other people co-signing for you. Sometimes you get a gift from a family or friend for the down payment, right? And you can get as little of a gift, or you can get 20% as a gift. Right. You actually don't have to have all the money yourself. You just have to have a gift letter, right? That says like, there's no IOU, no strings attached. That's basically what a gift letter is, right? From somebody that family or friend, right? So sometimes when you have the property and you're like, oh, I want to make it happen, all we need to do is like try to get a little bit creative and say, hey, how can we figure it out? That's really sometimes all it comes down to, is just getting creative. Not to say you're gonna go in, to too much debt, right? And you never want that. You don't want to be overextended or over leveraged, right? Be smart about it. This is how people get in trouble. But if you do it the right way and you kind of protect yourself and you feel good about it, you can make it happen. Okay. Kaylee, yeah, saw your note. I will be happy to send it to you. Maury, yeah, I'll send it to you. If you guys could send me an email on like ideal areas too, that would be really helpful. Here, let me put up my email on just because on properties like this, like they're not advertised on the MLS, right? I don't have beautiful, high definition photos, right? I've got basics. So it'll help me kind of pull together because I just have spreadsheets for this stuff. So awesome. Any other questions? Comments? Phone's dying. Oh no. Thanks, Sarah. Good to see you. Steve, you got any questions? You're like my token guy in the office.
I'm good.
You're good? Yeah, cool. All right, hey, if you guys don't have anything else, glad to help. Happy to be here as a service for anybody. If anybody has any questions, want to bounce some ideas off me, just reach out to me, send me an email, and I'd be happy to chat with you guys. Thank you guys. Thanks for joining.
Hey, thanks, John.
This was
Yeah.
great. Thank you, John.
Thanks. Good to see you on here. It's been a long time.
Yes,
Yeah. We'll connect soon.
absolutely. Peace, everyone. Have a good night.
See ya.
Thanks, John. I'll email you. I got your email now.
Oh, cool. Yeah, reach out to me and tell Travis I said hi. I haven't talked to him in a long time.
I will. I'll let him know.
Cool.
All right, bye.
Good chat with you. Yeah, see ya. All right, David. Thank you.
No worries. I'll save it and send it out tomorrow.
Cool. Thanks.